All right, welcome back. The one thing I like about our next guest is that more often than not, he's right, and he lays it all out there pretty clearly and in a simple manner, even that I can understand, right? Here are a few of his highlights for today, and he believes one of them is that the economy is going to accelerate faster than a lot of folks believe going into the second half of this year. He still hears many warnings about recession and stagflation, but he says he could not disagree more with these folks. The big, beautiful bill in D.C. adds more to our deficit. We've heard a lot about that, right? But although this debt and money printing that the government's become addicted to will probably end badly and maybe near term, a year and a half out, it's still like rocket fuel today for equity markets, right? Printing money is bullish for risk assets. So I guess there is a positive side of going more into debt, kind of, maybe, sort of. And finally, the Fed has gotten inflation data that can allow them to justify a rate cut or two this summer or fall. So that stacks up to be not too bad, right? He's got a few more good reasons. So we thought we'd have him on the show to hear it straight from the horse's mouth. Please welcome to the show Mr. Eddie Ghabour. He's co-founder with the Key Advisors Group. Thanks for coming on. He's in Delaware. All right, Ed, I didn't want to take all your thunder there. A lot of that was your notes. Any more thoughts? Do you want to put a little cherry or some whipped cream on that? Because I happen to agree with you. I come from a more negative point of view. I have managed money before for customers, and I always try to look out for the black swan, or how am I going to get caught off guard here? And so it generally does breed a negative point of view, and that's me. But even me being as negative as I am, I'm just having a hard time seeing why I'd want to be short or underinvested. I just can't see it.
I agree. I think, no disrespect to the shorts out there. You have to be nuts to, even if you don't want to go long, but the short this market is just too, it doesn't make sense to me. It's one of those things where I think you have to have the humility that when the facts change, that you change with it. And the bottom line is the facts right now are setting up a Goldilocks market. We've been buying this dip since April. We're pretty much fully invested right now with some of the highest beta that you can get, like small caps and discretionary names that have yet to get to their last highs. And we think they're going to blow through all of those. And one of the other reasons, on top of all the other things that I sent in my notes, is there's still a lot of people short this market that haven't participated. A lot of these CTA funds are being forced to buy. So you have natural demand in this market that's going to keep buying these dips. Now, can I see a 5 to 7% correction mid-June, late June going into July because we get overheated? Of course, it's not going to make a straight line up. But we have not been this positioned this bullishly since post-COVID when we got to 2021. And I think the setup, the next 20% is going to be higher in our opinion.
And so there's a lot of professional money that was on the sidelines and has missed the rally from the April 8th lows. I mean, your 5 to 7% might happen. Who knows? I mean, no, I don't have a crystal ball either. But, there is going to be a lot of money out there looking to scoop up some decent, prices. And if they do get something on sale, they're going to be in there to mute a lot of those, which might have been maybe a 10 to 14% sell-off. Now it's only a 5 to 7, if you get my drift.
Yeah, and so we think they'll be shallow. So this is nothing we were going to sell into because we do think that the economy is accelerating, and I think that data is going to show it. Look, we know the capital markets are smarter than any of us. There's a reason why this market is running up, because it's sniffing out that, A, we're not going to have a recession, and we're going to see growth accelerate. I mean, when the last data we got showed a huge wage increases for the consumer. Our consumers here in the U.S. spend this money, and this is why consumer discretionary names we're so bullish on, because we think they're going to benefit from this. And so, it's a great setup. And the other thing, too, is there's always risks. There's always black swans that we worry about, but we have to position ourselves for what's happening right now. And what's happening right now is this is a bullish trend and a bullish market, and we think we're going to go significantly higher over the next 6 to 12 months.
And let's just talk bad news for a second. I just feel like a lot of it was front loaded, and maybe a lot of it was probably in April, too, with a lot of the tariff talk and what might be happening to the economy. Again, we heard recession, stagflation, and there was a lot of that going on out there. And it was great to see, Scott Besson over the weekend talking to Margaret Brennan over at CBS about, hey, let's stop talking about what might happen and let's talk about what is happening. And we're getting the data that's coming through that is proving that your feelings are wrong and the facts are correct. And to your point about, the consumer, as long as you see the wages holding in there and jobs holding in there, the consumer is going to spend. I don't care what you say. We're addicted to it, just like Congress is. And so, again, lining all that stuff up with the fact that we've been able to secure, up to $10 trillion in capital commitments over the next 10 years from all those big companies that some of them in the Middle East and a lot of them here in the U.S. You've got the specter of maybe a rate cut or two because of what we just saw with the PCE and our inflation numbers. And you've got the big, beautiful bill that probably will get through. And then finally, we're going to have some more trade deals done. That's just going to be the fact. Tell me what's bad news about that.
When you look at the probability to set up in regards to headlines, because we know the markets react to headlines, when you compare the headlines we had at the end of March going into April versus what we're going to get over the next 3 months with a bill passing, with tax cuts, with trade deals, they'll be bumpy. It won't be a straight line, but the probability of positives versus negatives are far outweigh on the positive right now. And in our business, you're doing everything based on probabilities, and the probabilities continue to confirm that things are going to get better and markets are going to continue to make lower highs and higher highs.
And that's exactly how I feel. And just on a personal level, following your advice or whomever, I was a buyer late March, early April. And I was out on the stump. I was giving a lot of talks. I was doing some traveling around, doing some speaking engagements. I don't know if I would have bought if I was sitting at home with the television on, staring at my computer screen. I was just in a car thinking this is ridiculous, and I started to buy. And it was the smartest thing I ever did. Now I'm mad that I didn't do more, of course. That's always the way it is. But I think I got affected a little bit by all the noise surrounding us. I might have been, and thank God I wasn't. I was in a car listening to my wife talk, and so I decided it's time to take advantage, and it worked out. But I can see how people missed it because it was pretty dire there for a little bit. 10 seconds, too, before we got to go.
This is why we tell people, if you do things based off of a process that's math-based, you don't have to worry about the noise. It's easier said than done, but if the math is supporting it, who cares what the headlines are? Follow the process, and you will do well as an investor.
That's exactly right. Stay away from that noise. Awesome to have you on. You've been right so far. I think you're going to continue to be so. Can't wait to have you on again next week and see what you have to say. Thank you very much, Eddie. Eddie Ghabour coming to us from Key Advisors.